briefing underway, and what has been a really interesting kind of last, I guess, 48 hours. A lot of central bank commentary, and listening to the likes of Bloomberg TV this morning, a lot of people talking about the kind of coordinated effort, if you can call it that, by central banks looking to deliver a message, not so much of, I would say, being hawkish, but certainly being less dovish than maybe what markets have been accustomed to for such a long period of time. And the fact that you've had multiple different central banks, from the ECB, the Bank of England, the Bank of Canada, all following a similar kind of tact is quite unprecedented. It does kind of feel familiar as to when they all took coordinated action, but on the other way round. This was in obviously the heat of the main part of the financial crisis several years ago. So that's really dominated a lot of the press this morning. And one thing is, though, looking at the markets at the moment, US equity futures are sitting up higher, and we've had a generally positive close on Wall Street yesterday. We'll have a look at US bank stress tests, because last night US financials outperformed quite sharply. That helps certainly the recovery in the US equity market. Don't forget, we also had as well a fairly bullish response to the latest Department of Energy's crude oil inventory data. The US output down over 1%, very significant. That's much larger than your standard kind of deviation, if you like, of how much that percentage-wise tends to move on a weekly basis. And certainly it going lower is against the trend that's been materializing of late. And that also helped some of the recovery in equities. If you remember, this time yesterday we were talking about the S&P, which closed down on Tuesday night, 0.8%. That was the biggest fall in 6 weeks. Well, last night we rose 0.9%. So one day of one of the biggest down days which we've had in a long time, as you can see here, looking at the S&P chart, completely taken back and some. And in fact, just finding a bit of resistance up at, well, I would imagine these then are up close to record territory type levels again. So upside, certainly, if this trend continues, there's some decent levels here. You've got 47.5. You've then got the record high level, which is just around that R1 type territory, up at around 24.50. But looking at this, remember yesterday we were looking at this range that we had been in through the month of June, and although there is a growing chorus for equities at some point, for certainly if we start to turn more hawkish on a policy perspective, then you'd be interested to see whether equities can hold on to these fairly inflated prices. If you remember last week on Friday, Piers in the briefing showed you the kind of reversal that things like the euro, commodities or crude had made since the kind of Trump trade, but equities haven't. And so some would say there's plenty of room for downside in the right situation. But what we saw yesterday was we got to the bottom end of that defined range that we've been in since June, and that just acted as a really good entry point to get long the market again. As much as a lot of people are starting to question the sustainability of this move higher, ultimately it still proved a fairly solid tactic in identifying the lows of key ranges for equities then to come marching back higher, especially stateside. So really good rally last night, based on predominantly financials, but also the commodity sector. Looking at crude here, where we're trading at the moment, we're back above $45. So pretty decent move here when you think about where we were on this really sharp downward trend ever since the OPEC meeting. So I've still got it marked up here on the circle on the top of this chart. That was the moment of the OPEC, or the day of the OPEC meeting. We hit the highest level in some time, around $52. Then the kind of lack of or somewhat disappointment from the lack of action beyond that of just a 9-month extension, with US output increasing, saw prices going continually lower. But we've now come back up to a fairly interesting point here. So around R1 being that previous top that we had on the 19th as resistance, 45.28. So that'll be a first interesting test up here, and then you've got those previous support points above there at 45.48, and then R2 at just above as well at 45.71. So crude oil though, yesterday, the build in the headline. So a build, but not as big as expected. And as I mentioned, that US output number, despite the initial volatility, it ended up moving higher thereafter, and then we've grinded all the way up, generally speaking, through the Asian session as well to get back above $45. One other thing as well, if you're looking at those commodity-linked currencies like the Aussie, for example, I'm just trying to recall the percentage figure, but we've seen over double percentage increase gains in the likes of iron. So some of those base metals or industrial metals in Asia have certainly stabilized after what had been a fairly pressurized market, and that's certainly with crude moving higher. If gold starts to stabilize or in fact move higher, then certainly that might open up a couple of plays here in the likes of the Aussie in particular. If I'm looking at the Aussie currency here this morning, kind of is a reflection of that story. You can see we've just continued to move higher ever since really Europe has come in this morning. That does make sense from the performance of these commodity markets. Just having a look, a bit more longer dated here. It's the longest or the highest we've traded here in the Aussie in quite some time. Obviously I'm looking at the SEP contract here. Okay, so let's have a quick review of the euro currency, because this has been a real roller coaster in the last 2 days. And really it's two flashpoints of activity. Part one, this is your speech from Mario Draghi when he sounded, this was the thing, I don't think he sounded particularly hawkish. It was more just the fact of him just getting a little bit more upbeat about his forward-looking outlook, if anything, but the market really took it as a strong signal that the ECB are getting ever closer towards moving to a tighter monetary policy. The move continued in what was one of the biggest days we've seen in a long time in appreciation of the euro currency. What this led to then was a lot of belief that actually the market has overinterpreted what Draghi's intention was, which was actually, yes, economic conditions are improving, and yes, we are getting closer to doing something. But the way the market moved, especially strength of the euro, and in particular the sharpness of the move higher in German yields or European bond yields, was quite remarkable. Just looking at the Bund here, these were the two levels we were looking at yesterday. There was that really key level you can see marked up by these circles here from previous support and resistance points. But really big move that we've had to the downside. And if you look where we're trading this morning in the German Bund, down here, we've held on to pretty much a 3-point move. So a 300 tick move we've had almost in the German Bund, which is a huge shift in expectations upon what people are factoring in now from this new communication. So yesterday then, it was very interesting. The market had moved a lot. Draghi, we knew, was going to speak at the ECB forum alongside a panel discussion with other heads of central bank. This led to, though, as a bit of front running to that, an ECB source story. So this was your second kind of flashpoint here. And this was, as what some had expected, the sources basically said on Bloomberg that the market had misjudged Draghi's speech, and it was instead intended to strike a more balanced tone. Immediately, we dropped from around 114.25 to 114.41. So about 80 pips in a very quick succession, all the way down, fast money move, the kind of logical target for just hitting the market in quick fashion, down to pivot pretty much to the tick. But then Draghi started speaking, and they had the ECB forum, and actually he didn't give anything to say that he was changing tact from his original speech delivered the day before. The euro then recovered and has traded higher ever since. Now, actually, since Asia's come in, they've reviewed the situation. You've seen the euro break that kind of double top as well that was in play from yesterday morning and afternoon. And you can see the price just taking another push on the upside all the way up to what is today now R1. We've broken R1 then this morning on the second test. So again, resistance overnight, the Asian session. It's broke, come back. Now I guess it's about potential classic to go long. How much further can this euro go is the question from here, I guess. Certainly, if you look longer dated, this is the euro now on a much longer time frame. So we're encapsulating here now 2015, 16 and 2017. And you can see we've broken some really important levels here. For one, this was the spike that we had when we had a momentary blip in the US dollar before it recovered obviously strongly. This was the night of the US election. We're above there now. And having a look where else we've just broken above in this recent move, you've got the June high. So this was the night of around the EU referendum. You've also then got this cluster of resistance that was seen previous in 2015 as well. So pretty key levels here that the Euro's managed to surmount. Would say then that technically 115 certainly cannot be ruled out now to the upside. We are only trading about 25 pips shy of 115. And then above here you've got the May high 116.31, and then above there we start punching up towards 117 and above. So comparative to where we were just in April, which, you know, 3 months ago we were trading down at a 106 handle. A lot of this as well is economic data. You might have read the headlines this morning. This is one of them, and this is really a case in point where German IFO has been the highest since the early 90s. That's German companies being very optimistic about the forward-looking future. The German consumer morale is at its highest level since October 2001. This is German. French confidence as well is at the highest it's been in a very long time. First measurement we've had since Macron has come into power. Really made prospects in terms of forward-looking expectations much more bullish. So situation in Europe at the moment, you know, there is reason for Draghi to get a little bit more upbeat, certainly. And when these key economic drivers like Germany and France and their forward-looking indicators remaining at levels not seen for multiple decades, then it might start to explain then the reason why we keep moving higher. Also as well, from a bigger, broader macro perspective, if you think about the beginning of this year, we were down, really, we were talking about what about parity, we were saying, for euro dollar. When we got to the end of 2016, the beginning of the year, we were trading around 104 handle. That's because we had real risks politically in the market. You had the risk of a far-right politician getting some power in the Netherlands. You had the big risk about France, National Front and Le Pen. You had risks over a snap election in Italy. And all of these things have dissipated substantially. And so from a political and economic point of view, conditions are improving. Only one slightly soft spot, I would say, and this is similar for other central banks, although the one exception, probably the Bank of England, is inflation. If inflation doesn't start to tick up convincingly, then that could put a bit of a spanner in the works for their intention of tightening policy. But at the moment, those reasons probably make a bit more sense then. Why we've had this change in tone from Draghi, and also why the Euros had some pretty decent days on the upside. Okay, let's get into some of the news then, because there are some reasons why US equities recovered so confidently yesterday. And financials outperformed, and this became because we had stress tests. Now, this is the headline: that the FT are running this morning. Stress test clear big US banks for $100 billion payout. Might make a bit more sense if I quickly flip over to this one here. So this is Bloomberg's article. So essentially what they're saying is there's been 2 rounds of stress tests. The first round, if you like, what it looks at is how do a certain grouping of banks perform under adverse economic scenarios, i.e. if we were to see a massive downturn, i.e. another financial crisis, is the capital that these banks have in reserve enough in order to make that bank still able to function. This was obviously a part of the regulation that was brought in post global financial crisis in order that the banks are better safeguarded against events occurring that cannot be planned for. Maybe that's terrorism, maybe that's another blow up in terms of a financial instrument of an exposure that a bank has that maybe people are unaware of at this point. I'd say though, through the increase in regulation and transparency, the likelihood of that is probably lessened considerably now in this current economic environment. But what happens is, round 1 we had from the US banks, and round 1 is the test under these scenarios. Round 2 then is the banks will submit their plans for how much share buybacks or increase in dividends that they want to do. Obviously this takes capital out of the bank to pay out to their shareholders, and so this reduces then their capital levels. The second round of the tests then is an insight as to how would the bank then do once they've paid out. And so that's what we had yesterday. And JP Morgan, Citi, Bank of America led US firms unveiling a boost to dividends and stock buybacks, more than analysts had projected. So i.e. they've got more surplus cash or capital, and they can feed that out into the community, into their shareholders. Every lender passed annual stress tests for the first time since the Fed began the reviews in the wake of the 2008 financial crisis. And shares across the industry and the financials rallied late in trading in the US last night. Capital One financials did slip though 2%. It was the lone bank to stumble through the exam, garnering conditional approval. It was told to fix some material weaknesses, but all in all, they still passed the exam. So, looking at the banks here on the share buyback volume, you can see there's been a 90% increase here in the likes of, say, JP Morgan on the amount in which they're able to now push through and increase via share repurchases. So this is all positive signs in terms of the banking sector. Some other things here, dividends have gone up substantially. So this is the current dividends of some of these key US banks that you're familiar with, almost doubling in some scenarios. Citigroup, Bank of America, more minor increases for Morgan Stanley, JP and Wells Fargo. But you're looking at 100% increase when you're looking at Citi, for example. Going back to here, so it's an estimated in total $100 billion from the 6 largest banks, and all 34 institutions passed. So net, this is telling you that banks have basically built up substantial capital cushions that they could comfortably survive another downturn in a similar situation to the 2008 financial crisis. The fact that they have enough capital and surplus to that, enough to then pay out to their shareholders, is all seen as again a net positive for market sentiment. The other play, of course, yesterday was the recovery in the energy complex, that also helping lift its respective sector, and hence the reason why we had a positive close on Wall Street. The Nasdaq, which has underperformed, outperformed. That was up 1.5%. That led to a positive Asia Pacific session, and hence we've had a positive market open here in Europe this morning. In fact, just as I've been talking, gold in this kind of risk-on environment, having a little bit of downside pressure, just broken below what was the low print yesterday Looks like that's just extended to run down quite quickly to S1 before just bouncing here. But gold's just turning negative on the session. Looking at dollar yen, that's trading higher, just bringing dollar yen into shot. This makes sense as well from a risk perspective, that people are feeling quite upbeat this morning. So dollar yen moving higher, indicative of yen weakness. And so we've had a test up at R1, which looks like a pretty good level. That was also the high that was seen very early Asia Pacific session, up at around that 112, 15, 16 type level. Okay, a few other stories that you should be aware of. Theresa May, not sure how to describe the jacket that she's wearing in this picture. Looks like she might have been doing a bit of home DIY of some sort. But May faces further Queen's speech tests from Labour on Brexit. Don't forget, this was the talks between the Conservatives and the DUP that has been confirmed that they will have that Northern Irish Party support when this vote comes. And so really this should not prove to be too much of a disturbance, I would say, to the prospects for the pound on the intraday basis. However, of course, stranger things have happened, and I'll look out for exact timings when this is going to happen, but the vote is happening this afternoon, in summary, with a full vote on legislative programme scheduled for later in the day. So I guess it will probably go through 2 different rounds. But this is, again, the Queen's speech, the proposal which the Tories put through, which was somewhat watered down, obviously, given the minority government that Theresa May currently holds, but with the DUP backing, this should be a case of it goes through by a fairly slim vote. Looking at the pound at the moment, obviously the pound has not really, in the last 24, 48 hours, been reacting so much to the Brexit situation. Although we've had a lot of, let's say, disagreement, even within the senior cabinet members, such as David Davis and Philip Hammond, as well as Theresa May, the pound has been more driven at the moment by commentary out of the unreliable boyfriend, Mark Carney. That's what they call him. That term, that phrase, isn't mine. It is one where he used to be, of course, the governor of the Bank of Canada. And one of the reasons why he was so kind of warmly received when he first took over the helm at the Bank of England was that the Bank of Canada was one of the countries that navigated the financial crisis with most success. And one of the key policy instruments in which Carney used in that time, while he was running the Bank of Canada, was forward guidance. The only problem is that his forward guidance, which was more set for a 2-year horizon, it pretty much hit his objectives in about 3 or 4 months. And therefore then he started moving the goalposts. Forward guidance, as we know now, is kind of lesser used, I would say, because as we know from the Fed from 2016, they were supposed to hike 4 times, they only hiked once. So forward guidance in terms of how the market trusts that view or the forecasting that banks give them, they're a little less believing. But what this has brought about then is the credibility of Mark Carney, because yesterday he obviously spoke at the ECB forum, and yesterday he made the comment, and his exact words were, "Some removal of monetary stimulus is likely to become necessary if the trade-off facing the MPC continues to lessen and a policy decision accordingly become more conventional." So some removal of monetary stimulus is likely, he said. Don't forget, earlier in the week he said there is no need to raise interest rates, not with anemic growth and mixed signals on consumer spending. You've had one guy go from far dovish, if you like. Haldane came out and was quite hawkish, so then we've had a bit of a balanced picture. Then Mark Carney's then flipped back into being more on the hawkish side, and we've just found out this morning that this is off schedule, so it's a new update to your daily schedule, that Mark Carney is going to be interviewed on Bloomberg TV at 11:30 a.m. Now, if you're trading the pound, this is a definite event that you need to be monitoring very closely. This is kind of classic 101 communication tactic from a central bank. He has given the market, or the market has interpreted what he said with a high degree of volatility because of the mixed stance which he has communicated. What he's trying to attempt to do this morning, or I'm sure he will do, is to clarify exactly what it is that his intention has been. And so this is when you get these kind of impromptu speeches. And so at 11:30 you must be watching Bloomberg to see then, does he unwind some of this hawkish rhetoric from yesterday, and does he go back to the dovish speech that he delivered where he talked about no need to raise interest rates at the moment, be at the beginning of the week. Now, where the market is positioned is certainly for a more hawkish outcome. We are trading back to a 130 handle now in cable. I'm just looking here on a slightly longer dated chart. If it updates, there you go. This is a daily continuation chart. And if you think about when Theresa May called the snap election, we jumped higher in price action. We then defined a high on the daily charts at 130.59. We're trading just below there at the moment. So we're coming back up to quite a key technical level for the pound. Now, one theory that I was talking to a few people about yesterday was about how about we know that the weaker pound has been the real contributing factor to the elevation in UK inflation. There were concerns that on the hung parliament we could have been looking back down towards this 120 or a breach below there, which was would have been the low, certainly post-EU referendum. Pretty strong level of support that has been thus far. Obviously, the lower the pound gets, the worse of the inflation problem. The worse of the inflation problem, the more impact it has on the UK consumer and confidence, and therefore net the economy. So, why not use communication, sound hawkish, talk the pound back up in order to mitigate then rising inflation, with the overall objective then you don't actually need to do anything, because then the peak of inflation holds rather than it continues to rise. It's quite an interesting theory. Whether or not that is the case, I think you'll know at 11:30 as to whether or not he sticks to his guns on how the market is positioned. He will know full well where we're trading in the market at the moment at 130. And with Brexit uncertainty looming on negotiations going forward, I would say I don't think it's a bad tactic to sound a bit more hawkish and keep the pound up, because you know that there's going to be negative headwinds coming from the Brexit talks, and you'd want to keep sterling currency fairly stable rather than it remaining under pressure, which would exacerbate the inflation issue. So just a couple of thoughts on that, but certainly 11:30 very important for the session today. Just seeing gold here, another little push here, just broken S1 now. Dollar yen. So look, let me just bring these risk assets in while I'm talking. Gold just breaking then. You had that previous test on S1, a break on that now, extension to the downsides, down $5 on the day, and then that coinciding with the yen break on that high we were just looking at, and then we get a bit of an extension there. So if yen and gold continue these movements, then it'd be interesting to see how these other assets start to play out. Does it start to feed through into a little bit of renewed confidence in the equity space? Possibly. Okay, just looking at the calendar then to round things up. We have had through this morning, a couple of German state CPIs have come out. You've got Saxony, the first state came out 0.2%. Previous was minus 0.1. The year-on-year up 0.1%. Hesse has just come out. Bavaria and Brandenburg all showing higher inflation in June against the prior month. This is all the more signals then for potential further support for the euro currency in the short term. If you remember, the one kind of fragile spot is inflation going to remain on target? Because it's faltered in regards to the US of late. But if that starts to fit in with consumers and companies remaining confident, and the ECB then by default turning more hawkish, then certainly that helps support the euro currency going forward. Other than that, looking at this morning, UK mortgage data comes out at 9:30. I think it was nationwide house prices that came out yesterday and showed a surprisingly strong beat on expectations, albeit London was fairly muted. It was the rest of the country actually that was seeing the best advance. But mortgage lending data to be watched, I guess, just given the investment decisions, given the uncertainty over Brexit. Would this be a time where consumers want to be taking mortgages? Probably not. But will this data have an impact in sterling currency on the intraday? Also, probably not. Again, the bigger factor will be Mark Carney at 11:30. Going forward, there is a cluster of European data at 10 o'clock. It looks like it could be interesting when you hear the words economic sentiment, business climate, consumer confidence, but these are all second-tier numbers. These aren't actually anywhere near the kind of scope of, say, German IFO or ZEW from an impact potential. You get the German, then pan kind of national CPI figure at 1 o'clock. By that time, we already know, and as per the various German states that have come in, that's going to show a minor uptick. The national reading is just the kind of summary, if you like, of all of those put together, so it's not market moving either. But going into the afternoon, there are a couple things to be aware of. You've got the final reading of US first quarter growth, core PCE numbers, and the weekly jobless claims. Of course, it's Thursday, so look out for that. And then Fed's bullard, really for the guys trading in trading live room later on in the FX markets. You've got Fed's bullard speaking on the US economy and monetary policy later at 8 p.m. Okay guys, that's your briefing for this morning. I'll leave it at that. Just gone through 9 o'clock, so have a good day and I'll see you in the chat room. Thank you very much.